And by the way, if they don't revise GDP downwards, then the conclusion is that the productivity situation is even better than the numbers showed last year and so far this year. And that's another theme of our uh, view is that when we look back on this decade, we'll conclude that it was the roaring 2020s, where companies did, in fact, use technology to significantly increase productivity. And productivity is like fairy dust. It's magic. It makes everything better. Better than expected productivity makes real GDP better, keeps inflation down. It allows wages to rise faster than prices. Real wages go up, and profit margins improve. So I think we're in that kind of environment, and the stock market goes up to S&P 500, 8,000 by the end of the decade. The Dow Jones gets to 60,000, and we all live happily ever after. Unless, of course, everybody reminds me, yeah, but the 2020, the 1920s ended badly with a crash in the Great Depression, and so I'll grant you that we may have to revisit this as we get to the end of the decade for that kind of possible scenario.
On this episode of the What the Finance podcast, I have the pleasure of welcoming on Dr. Ed Yardeni. So Ed is the president of Yardeni Research. And if you want to find any of his sort of thoughts online, I believe it's yardeniquicktakes.com. So Dr. Ed, thanks so much for coming on the podcast today.
Sure, my pleasure.
No problem. I look forward to speaking. We've just sort of had some information from the Fed come out sort of 2 hours ago. This will go up in a few days. But I like to start sort of all my interviews just asking, what are your current thoughts on what we're seeing in the economy globally?
Well, we've been optimistic on the U.S. economy for a while. As a matter of fact, back in 2022 and 2023, when people were very pessimistic and lots of economists were talking about a recession, we said, yeah, the economy is in a recession, but it's a rolling recession affecting different industries at different times, and that the economy would prove overall to be quite resilient. And that continued to be the case in 2024. We still have some what I call die-hard hardlanders. People are convinced that tight monetary policy must mean that we have to go into recession, or who believe that the only way to bring inflation down was in a recession. So there are a few of these people still talking about us being actually in a recession already or soon will be. And we've been pushing against that idea for a while. We're also pushing against the idea that the Fed has to lower interest rates many times in order to keep the economy growing. We think the Fed has succeeded in normalizing interest rates. This is kind of where they should be. The economy has demonstrated it can handle it. And I think these are rates that are only fair to investors who don't want to take any risk and want to stay in money market funds or other short-term instruments. On a global basis, we've been pessimistic on the prospects for China. By the way, one of the reasons we said that inflation could come down in the U.S. without a recession here is because they were having a recession in China, particularly in the property market. And as a result, they're pumping out exports like mad at discounted prices. So they're exporting deflation. And one of the reasons inflation's come down so quickly in the United States is because consumer durable goods inflation has come down. A lot of the import prices have come down. Europe looks like it's trying to recover, but it's a fairly sluggish recovery from, let's call it a growth recession. They just really haven't been growing much. Germany's economy is facing a lot of competition from manufacturers overseas, particularly in Asia and most particularly in China. They used to have a great business selling Mercedes and BMWs in China, and now they're finding that business is not as strong, and they're competing with electric vehicles coming out of China. But all in all, the global economy looks like it's muddling along. Commodity prices aren't doing much, which kind of confirms that.
Okay, great. Thanks for outlining it. So at the start, you
Sure.
mentioned that you thought there was sort of a rolling recession with the different industries going through it at different times.
Right.
Why did you think that? And I guess is that sort of something that we've seen in the past?
Well, the it was logical to expect a recession. After all, the Fed went from basically a 0% federal funds rate in 2022, in early 22, March 2022, to raising interest rates to 5.25, 5.5% by the spring of 2023. So surely a increase in the federal funds rate of over 500 basis points, kind of comparable to what we saw when Paul Volcker was fighting inflation. Surely that must cause a recession. And we observed that, look, the Fed's tightening from zero. The abnormality wasn't 5.5, 5.25, 5.25, 5.5%. The abnormality was zero. And to a large extent, the Fed was really just normalizing. We also felt that the economy was less interest rate sensitive. Clearly, housing responded in a typical fashion. It took a dive on soaring mortgage rates, but we were careful to point out that multifamily was doing quite well in terms of housing starts because there was a great demand following the pandemic for people to move down south, and a lot of them wanted to rent. So multifamily residential construction was actually very, very strong. On the good side, we observed that we had a buying binge coming out of the lockdowns in early 2020 in the US. And as a result, when people were able to go shopping, they couldn't find much in the way of services. So they went on a buying binge for goods. We had this huge increase in buying of consumer durable goods uh, in 2020 and 2021. And then it kind of petered out. But what's interesting, it didn't. They didn't stop buying consumer durable goods. It just kind of went sideways at an all-time record high. So I think it's basically been catching up with its slower upward trend that started pre-pandemic, that had been going on since the pre-pandemic. And as they kind of decided, one of the reasons they decided they didn't want to buy too many more consumer durable goods, because not only did they buy everything they wanted, but then the service economy started to open up and they started to travel more and go out to entertainment venues more. And so there's a lot more spending on services. And then the economy has become less interest rate sensitive in capital spending. 50% of capital spending now is technology capital spending. And technology is not that interest rate sensitive. A lot of companies institute their technology spending programs, their capital spending programs, with the idea of increasing productivity. And then the other thing that's interesting about technology, especially software, is you don't have to buy it, you can rent it, which means that you don't have to put a large sum of money out to buy these software products. You just rent it, and higher or lower interest rates aren't going to affect that decision. And then, of course, we had tremendous stimulus on the fiscal side and monetary side that still left a lot of stimulus for the economy in 2022 and 2023 to offset the tightening of monetary policy. There was still lots of liquidity in the system. People were still sitting on quite a bit of excess saving. And then the other thing is, a lot of the economists who predicted the consumer would peter out based it on the idea of excess savings, that they would run out of excess savings accumulated during the pandemic. During the lockdowns, they couldn't spend much money. And then, of course, they got 3 rounds of checks from the government that was saved and then increasingly spent. And the expectations were that they'd spend it all by the end of 2023, or surely by 2024. And the evidence is that that's, in fact, what's happened. But they're still spending. Well, that's because consumers basically and historically are driven by employment and real wages. And employment has been continuing to increase, granted at a slower pace, but a pace that's consistent with the pre-pandemic growth in the labor market. Real wages have actually been increasing. I know everybody complains that prices are a lot higher than they had been, but wages are up as well, and in most cases offsetting the price increases. And finally, I'd say that the pessimists, the naysayers, the diehard hardlanders completely missed the retirement of the baby boomers. The baby boomers are retiring. My friends are all retiring. I'm still working for a living because I got 5 kids, so I got to keep going. But by the way, I also enjoy it. But a lot of my friends are retiring. They only had 2 kids, and they're not selling their homes. They refinanced their mortgages if they have any mortgages. Most of the baby boomers paid off their mortgages. They got no mortgages. They got no college fees to pay for, and a lot of them managed to accumulate a fair amount of assets, whether it be in real estate or stocks or bonds or wherever. It's like Leonard Nimoy, Spock said in Star Trek, "Live long and prosper." A lot of my friends, baby boomers, God bless them, are living long and they've prospered. Their assets have compounded. They've increased in value, and now they're spending the money. When you retire, you no longer think about how much do I save out of the income I earn, but rather, how much of what I get on my assets and interest and dividends do I spend? And if that's not enough, how much do I go into my savings? So I think they missed. I think a lot of the pessimists missed that.
Okay, makes sense. Yeah, there's a lot to again a lot of points touched, but I think that's a thing. It's such a complex system and so many different
It
variables
is very
involved.
complex. Yes.
But yeah, and today we actually got some employment data. So they were talking about that they overstated. I think it was non-farm payrolls were overstated over the last year by some 800,000 jobs. What
Right.
impact do you think this will have? Is this more just saying that it wasn't as fast as expected? Yeah, what are your thoughts?
Mhm. Well, not much. I mean, nothing's changed other than the numbers changed. But when you look at the number, it's still like around 170, 180,000 per month on average, which is kind of back to normalization. It's back to pre-pandemic levels. That's a basic point of theme of my work is that we've normalized since the pandemic. A lot of things were abnormal, and even before the pandemic, we had this long period of abnormality with zero interest rates. So we're back to a normal situation in the labor market. And by the way, if they don't revise GDP downwards, then the conclusion is that the productivity situation is even better than the numbers showed last year and so far this year. And that's another theme of our uh, view is that when we look back on this decade, we'll conclude that it was the roaring 2020s, where companies did, in fact, use technology to significantly increase productivity. And productivity is like fairy dust. It's magic. It makes everything better. Better than expected productivity makes real GDP better, keeps inflation down. It allows wages to rise faster than prices. Real wages go up, and profit margins improve. So I think we're in that kind of environment, and so far so good. I think the data, it's not so much a forecast anymore. It looks like the data is actually confirming it. But the decade's not over, and a lot of good things and bad things can still happen between now and the end of the decade.
Yeah, do you take into play? I know a lot of people are talking about. I guess there's been quite a lot of legal migration to the US. Could that be something else that's maybe not recorded in the economic data that could be impacting?
Yeah, that's part of our story. Is that the recent increase in the unemployment rate over the past year has more to do with new entrants into the labor market than people actually losing jobs. Layoffs are actually down to historically low levels, and so it may be that some of this illegal and legal immigration is creating more of a supply of labor, which is a good thing. Historically, we know that immigration actually boosts economic growth as long as the immigrants want to come and do a good day's work. If they're all coming in to take advantage of a social security safety net system, that's a whole different story. But to a large extent, when people take the kind of risks that they take when they immigrate, especially illegally, a lot of them do want to work hard and improve their standard of living for themselves and their families and live in a more peaceful environment. So I think on balance, immigration is a positive for an economy. There are, of course, all sorts of side issues related to uh, social instability, which can detract from all that. But for the United States, I think what we're discovering is that net net, the immigration inflows have increased the number of workers and also have obviously increased consumption of goods and services.
Okay, yeah, that makes sense. So you mentioned you see there's normalization of, I guess, the economy. So we could say inflation. You said employment. Would you say sort of growth as well? So you think that's maybe going to go back to where we were pre-COVID? Is that sort of your, I guess, your base case moving forward, or do you think?
Yeah, yeah, I think we go back to where we were before COVID, but I think we could do better than that. I think we may be doing better than that because I think the difference will be better productivity growth. And I think the technological revolution that really started in the 1990s has been evolving. And I think it's evolved to the point where a lot of the technologies that are available today are a lot cheaper, they're a lot more user friendly. You don't need to have a lot of IT people supporting it. Some of that software gets automatically updated if you're renting it. And so I think the technologies that are available today, including the cloud, of course, all these technologies have the potential to cut costs and increase productivity for a whole host of businesses. Whereas in the late 1990s, a lot of the technologies were pretty limited in what they could do to boost productivity. If you had a lot of secretaries on IBM Selectric typewriters, you can replace all of that with Word. If you had a whole bunch of bookkeepers and accountants, you could replace a lot of that with Excel. But other than that, technology wasn't all that productivity enhancing as it is, I think, today. And I'm of mixed opinion about artificial intelligence. I think some of it is hype, but I do think that quite a bit of it is going to be and is already starting to have a significant impact on cutting costs and increasing productivity. We've heard that recently from a big company like Walmart that said that it's very effectively using AI to manage inventories, to lower inventories, and to provide a better experience for the consumer.
Hey everyone, sorry for interrupting. I just wanted to extend a massive thank you to you for listening and tuning in and for your support over these 3 years. So we've had, hundreds of guests that we've welcomed on the podcast. We've had millions of views with hundreds of thousands of different people listening in. So I just wanted to thank you. I started this as a student. I'm now currently working and I've always done this on the side just because I have a passion for it and I've enjoyed it. And probably similar to yourself, you listen to all these, different YouTube channels and podcasts of people listening to different guests. That's how I started, and I just wanted to sort of take the plunge and be able to have the opportunity to speak to these people, and you've made that happen. So thank you very much. Just myself, don't make any money from this, and it's really a passion project. So thanks for supporting that passion of mine. If you wanted to support the channel, all I ask is if you could like, subscribe, or even comment, positive or negative feedback. I'm always willing to take constructive criticism. I'd really appreciate that. But otherwise, thanks so much. If you can believe it, only 14% of our listeners actually subscribe to the podcast. So yeah, if you can, great. If not, no problem at all. Thanks for listening, and yep, let's get back to the show. Yeah, I agree. As you said, there's going to be the good and the bad, and the hype and the actual benefits there. If we go to, I guess, monetary policy, you mentioned there that you think interest rates, should stay at this similar level or shouldn't go down too far. I guess why is that? And do you think maybe the risk would be the fiscal sort of drag that we'll see with increasing interest rates?
Yeah. Well, I think we still somewhere in the back of our minds have this mentality that we could be going back to zero interest rates that was normal, but that was abnormal, clearly. And I think the central bank's obsession with zero interest rates because they were obsessed about not their inability to get inflation back to 2%. That wasn't too long ago. Remember when central banks were hoping they could get inflation up to 2%? That kind of all blew up in their face over the past couple of years. But I don't think we're going back to abnormally low interest rates. And my main concern, if interest rates are too low, is that once again they create a misallocation of capital and where it should be going. And I'm particularly concerned about a potential melt up. I wouldn't like to see a 1990s kind of scenario. I've been saying, look, there's three kinds of alternative scenarios in my imagination of what could happen. 60% I would assign to the roaring 2020s, which is a beautiful story. It's productivity led. Stock market goes up to S&P 500, 8,000 by the end of the decade. The Dow Jones gets to 60,000, and we all live happily ever after. Unless, of course, everybody reminds me, yeah, but the 2020, the 1920s ended badly with a crash in the Great Depression, and so I'll grant you that we may have to revisit this as we get to the end of the decade for that kind of possible scenario. And by the way, I really think that what really caused the Great Crash in the Great Depression was the Smoot-Hawley tariff. So if the government under Trump, I suppose, comes up with a tariff that cuts off world trade, that could certainly create a stock market crash and a depression. So I'm very cognizant of that. But I'm not giving you 100% on roaring 2020s. I'm giving you 60%. 20%, an additional 20% would be the 1990s all over again, in which case the Fed would make the mistake of saying, basically saying mission accomplished. We've brought inflation down. It's down to 2%. Now we're once again concerned that it might get lower than that. Meanwhile, the economy is doing just fine. So what the hell? Let's lower interest rates. And what you get out of that is a bubble in the stock market, perhaps led by the Magnificent Seven, AI-related stocks, and the rest. And then, so 80% of things are going to be pretty happy in terms of either the short term or the long term. And then 20% not so happy. The geopolitical risks out there, which are, the hot war between Ukraine and Russia, the hot war between Hamas and Israel that might spread to a war between Israel and Iran. If any of those become much hotter and lead to a spike in oil prices, that could cause a recession and a bear market. The history for us, at least in the United States, shows that recessions are caused either by tight monetary policies that lead to credit crises, credit crunches, and a recession, or else a big spike in oil prices that depresses consumer spending and capital spending. We have seen tighter monetary policy, but the Fed last year did a great job of averting a credit crunch by stopping the credit crisis that occurred in the banking system in California in March of last year. So hence, we haven't had a credit crunch and we haven't had a recession. And so far, there seems to be just an ample supply of oil, especially with the U.S. producing at a record 13 million barrels per day in the oil fields. And that's even with under administration that promised to, shut down the oil industry. Well, that didn't happen at all. And so there's plenty of oil around. And of course, China is in a very weak state. Europe's not doing that great. So there's plenty of oil around. And we're not seeing a spike in energy prices, even with the risks to the supply that are inherent in the war between Ukraine and Russia and in the war, the undeclared war between Iran and Israel.
So if you were the Fed, would you keep interest rates where they are? I know today they've sort of positioned that they're looking to maybe do one cut at least next meeting, and I didn't see if they're sort of thinking any more for the rest of the year. But would you keep it as it is? Would you maybe bring it down to 3% or something? What would you do?
Yeah. Well, if you made me Fed chair for the day, I'd say, you know what, the economy's doing well, inflation's coming down, and we're doing this with the current level of interest rates. Why mess with success? However, at the Fed, they had this view that now that they've got a balance between their dual mandates of unemployment and inflation, they had this view that they now have to get somewhat more attention to the unemployment rate that has been rising. There is a so-called SAM rule that has had a history of being somewhat predictive of recessions, but all these rules that have worked in the past for predicting recessions haven't worked, and I think this one won't work either. But again, the logical idea is inflation's coming down. If you leave the Fed funds rate here, then inflation-adjusted interest rates, real rates go up, and wouldn't that depress the economy? And my answer is no. It's ridiculous to look at the federal funds rate, which is an overnight rate, and adjust it for the year-over-year inflation rate. I don't know of anybody who makes an economic decision based on the real Fed funds rate. People do make decisions on the real bond yield, undoubtedly. But again, the proof is in the results. If the economy is performing well, inflation's coming down at these levels of interest rates, what's the rush to lower interest rates, especially with the stock market already showing some pretty heady valuation multiples? So, on the other hand, Fed may also want to stimulate housing somewhat, though we have seen the bond yield already come down quite a bit, and the mortgage rates come down. So I think housing will in fact, strengthen up ahead here. But all in all, I'm, benefit of hindsight, I'm definitely happy that the Fed did not go into emergency mode earlier this in August when the stock market took a dive around the world, including in the United States, when these so-called carry trades started to unwind. A lot of speculators had borrowed in Japan at zero interest rates, and then they put some of that into the stock market in Japan, and they put quite a bit of it also maybe in the Magnificent Seven and other assets that were doing well. So it was a great trade. You borrow money for nothing, and then you put it in something that goes straight up. You make a lot of money, and it works until it doesn't work, because earlier this in August, the Bank of Japan indicated they were going to start raising interest rates more aggressively. The yen started to really strengthen, which started to really create problems for the people who had borrowed in yen. And so that whole thing started to fall apart. And then there was some hysterics out there saying the Fed's got to lower interest rates today. They got to do it by 75 basis points. My goodness, if they had done that, that would have worsened the carry trade, because the yen would have gotten even stronger. The dollar would have gotten even weaker. So I think there is an issue for now that the Fed doesn't want to get too dovish, because that again could create an unwinding of the carry trade. Because if the market concludes that the Fed's going to do a lot of rate cutting, then the dollar really goes down, the yen really goes up, then that would put another wave of pressure on these carry trades, which could have adverse impacts on the financial markets. But again, fortunately, it didn't last very long, because the Bank of Japan announced that they're going to hold off on raising interest rates for a while until things calm down.
Yeah, great points. And I guess the one thing that probably people would push back on is that if we keep interest rates as high as they are, both parties seem to not be worried about the deficit. They almost seem to want to expand it. I know some people talk about tax rate rises, but yeah, but I guess
Yeah,
there's the risk that if we keep interest rates as high with deficits continuing to expand, that the interest repayments are going to start taking up a larger percentage of the budget, and it's going to sort of make it
yeah,
worse. Do you see that as a possibility?
yeah. But let's face it. If the Fed lowers interest rates here, and one of the reasons that they are doing that is because they want to reduce the cost of financing the debt. Guess what? We're going to get even more borrowing, one way or the other. We really are an unsustainable path from a political perspective. Nobody's interested in doing anything about the deficits, because we've been getting away with it. We had something that looked like a debt crisis, something Ray Dalio has been warning about for a while. We had something that looked like a debt crisis in August, September, October of last year. That was just a glimpse of what could happen if we don't at some point really get a handle on reducing uh, the growth rate of outlays and increasing the growth rate in revenues. As we know, the Democrats want to increase outlays a lot more, and the Republicans would like to keep tax cuts and maybe cut taxes some more. So I get the point about the Fed being concerned about the deficit, but they'll tell you over and over again publicly it's not their job to worry about the fiscal side. Their job is inflation and unemployment, and if the fiscal side has some impact on those variables that requires them to do something, that's when they act. But they'll tell you that fiscal policy is out of control. They'll just acknowledge that it is, but it's not their job to do anything about it.
But I imagine those lines would potentially blur if that were to sort of leak into the financial markets and other parts of the economy, and that's
Yeah,
where they might have to interact and
yeah.
with, yeah, the treasury and whatnot.
Well, I guess you can posit a scenario where we get a debt crisis, uh, much more severe than what we had last year, and the bond yield goes back up to 5%, and that causes the economy to fall into recession. Maybe that's the event that would finally force the politicians to address the long term, just put us back on a long term sustainable path on the deficit, which might be enough to placate my friends, the bond vigilantes. Like I came up with that phrase back in 1983. And the bond vigilantes looked like they were pretty aggressive there last year, but they've calmed down ever since because inflation's come down because the Fed's been the Treasuries have been financing the majority of the deficit with bills, um, and that's kind of calmed the bond market down. But yeah, I mean, if we have another debt crisis that's more severe, maybe that's what it'll take to get a political response to it. Look, people have been worrying about the deficit forever. I've been in this business for over 40 years, and the doom and gloom crowd has been warning us about that for a while. And my attitude has been, I'll worry about it when the markets are worried about it. And so I was somewhat worried last summer. I'm not worried right now.
Okay, that makes sense. So, you mentioned there's a sort of a potential 20% potential that what happens in the 90s happens again, where they cut down to two, probably lower. Job done, inflation defeated. Do you think then asset prices would just accelerate a lot quicker than the first scenario and potentially even higher, or
Mhm.
how would you see that?
Well, in the 1990s scenario, Um, I'd say the roaring 2020s are, rhyme with the 1920s. The 1990s scenario is a melt up in financial assets. Certainly looked like we were heading that direction even a few weeks ago when the stock market got to an all time record high on July 16th. And so it's conceivable that with valuation multiples around 2021 on a forward basis, with the Magnificent Seven around multiples of 30 times forward earnings, I mean, if those things keep going higher, it'll make us even more vulnerable to any sort of setback, particularly a geopolitical one. And that's that other 20% scenario, which is, I'd say it's, if I had to compare it to a decade, I'd say it's the 1970 scenario where we had two energy price spikes related to geopolitical crises in the Middle East. And that created a decade worth of misery of rising inflation and a couple of recessions and so on.
Okay, so I know it's folly to predict, but what do you think the Fed will do? Will they sort of take it nice and slow and slowly go down, or is that not, you know?
Yeah, I think this Fed is fairly conservative in terms of how quickly it wants to act. I mean, it did act very aggressively in raising interest rates once they realized they were behind the curve, but that's because they really felt like their credibility was on the line. So they moved very quickly to raise interest rates once they realized that. Now I think they might take their time if the data continues to show that there's no reason to rush. If the economy continues to perform well, and I think like everybody else will be watching the weekly initial unemployment claims as a weekly indicator of what the labor market's doing. Um, I think it's pretty clear inflation is going to be coming down to 2% fairly shortly. On a CPI basis, we're already slightly below 2% if you exclude shelter. And the reason that's a legitimate thing to do is because we all know shelter inflation lags behind actual current rents. It kind of reflects what rents are over the past 2 years, not what the current rents are. We know the current rent inflation has come down a lot. And so, we're pretty much locked into a course here to get down to 2%. And then lo and behold, what happens if we're suddenly worrying about being below 2%? Um, so that's another scenario, perhaps for another time when we get when that becomes more realistic. Right now, let's just concentrate on we're still above 2%, but we're probably heading to 2%. But again, what's the rush for the Fed to lower interest rates?
Yeah, great point. As you said, it when the economy's strong, just keep it going, slowly cut as they are. So in sort of, it seems like in the majority of scenarios, you know, tech is probably going to be the highest performer. But what other industries do you think will maybe do well in that scenario?
Well, I think now that we all agree that the Fed's done raising rates, and we're just arguing about you know how much they'll be lowering rates. I think the latest news coming out of the Fed, the minutes suggest that yes, indeed, we can all expect 25 basis points at the September meeting. But there's still people who think there'll be two more cuts in November and December. There's people who are thinking there'll be six, maybe eight cuts over the next 6 to 12 months. Um, I think the Fed needs to push back against that the way they did earlier this year. Earlier this year, at the beginning of the year, there was people talking about numerous rate cuts, and we haven't had one so far. So I think in an environment where we're looking at uh, no more raising of rates and lowering rates. The only question is how quickly, how far, how many. Uh, I think that that's generally favorable for the bond market and generally favorable for the stock market. Um, the bond market's already discounted a lot of that. So if we're right and the Fed starts pushing against the idea that there'll be several cuts coming, bonds may get back to 4.25%. And that's because the economy is doing better than the bond market and the Fed have been thinking. Um on the other hand, the stock market, with normalized interest rates and the economy doing fine and earnings rising into a record high in the second quarter of this year, there's no reason why the market couldn't continue to go higher at a gradual pace. And we're using 5,800 on the S&P 500 by the end of the year. It's currently at 5,600, and 200 points from these levels isn't a big percentage increase, and it wouldn't take much to get us there. And we're still looking for something like 6,500 on the S&P 500 within the next 12 to 18 months, and then, as I said, 8,000 by the end of the decade. Well, industries, I think it would be a pretty broad rally, right? I mean, the we've already gotten the hint that the small cap, mid cap stocks like the ID of low interest rates. The Russell 2000's done better. I think we'll see a broadening in the market. It may very well be that we'll go from all the focus being on the Magnificent Seven to the maybe a little less magnificent, but perfectly attractive um, S&P 493. There's still lots of stocks that have lagged behind the Magnificent Seven. They've actually done pretty well. They just haven't performed as well as the Magnificent Seven. But in terms of naming names for sectors, I'd say we continue to recommend overweighting technology, industrials, financials. We'd even overweight energy, not because we're big believers that energy has a great future, but because it's a good shock absorber in the event of geopolitical uh, problems causing oil prices to go up. So we're pretty much focusing on growth and increasingly willing to consider that the market is broadening so that there's more opportunities beside other than the Magnificent Seven.
Okay, so Dr. Ed, thanks so much for your time today. Really appreciate it. No problem at all. And my last question is, what is one message you'd like people to take away from our conversation?
Well, look, I think that there's been too much pessimism out there. I love the pessimists; they do great work. The economists who are perma bears do great work. I read them very carefully, and all I try to do is provide some balance. And maybe by doing that, I get labeled as a perma bull. But I don't really mind that. I view that as a compliment because on average the market goes up rather than down. And just one last commercial. If people want to follow my work, just go to yardeni.com, yardeni.com, and you'll see the institutional product we have and the individual product. The individual product is at yardeniquicktakes.com, and that's a daily. It's short, but it's been pretty good in trying to assess the impact of the macroeconomic data and environment on the stock market.
Great. I'll put all those institutions below. So, Dr. Ed, thanks so much for coming on the podcast today.
My pleasure. Thanks for the opportunity.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment. You know, good or bad feedback, I'm always open to that. But it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right, thanks again.